Sales variance, the total sales variance is split into the price and the volume. Sales is equal to basically the logic of what is sales. Sales is equal to number of units into the selling price per unit. So the total sales is split into price variance and the like we have quantity variance, here it would be volume variance. So the number of units which are sold. Now, yesterday we have learned about two different types of accounting systems, which are marginal costing system and the absorption costing system. Considering marginal costing and absorption costing system, we understood that there is a difference of opinion in terms of what is profit. Now, profit is according to absorption costing, sale profit would be the total sales minus the total cost is equal to profit. Under marginal costing, it is sales minus variable cost is profit, but that's controllable profit. So that is what we have it. So when this is split into price variance and volume variance, the difference in the price, the budgeted price, the actual price, okay, applicable for the actual number of units sold, that is sales price variance. Volume variance is the difference in the number of units, standard units and the actual units, applicable at whatever is the profit. Either it is contribution or it is full profit. There is an example question which is given here. It says that sales is 580 units, selling price is 13, variable cost is 4. The actual details are also provided to us. So let's work it out in the Excel sheet. Okay, it's a little better. The details are given to us. The number of units under budget, under actual. Then we have the selling price under the budget, under the actual. Then the variable costs are also given. In this case, what is the sales price variance? If we have to find out what is sales price variance, would be the difference in the price, that is the budgeted price and the
Ma'am, Excel sheet is not visible.
okay, just thank God. The actual number of units are 620 into the difference in the selling price. The standard selling price, budgeted selling price is 13, actual selling price is 16. The answer here is equal to 620 into the difference is 3. Should it be favorable or adverse? That is the situation. See, they decided that they would sell it at 13, but in reality, they ended up selling it at a better price. They got more amount of revenue because this is revenue. If the actual is better than the standard, it is favorable. In case of cost, actual should always be less than standard. So that is what we have understood. In case of sales variances, it should be the actual should be better than the standard. Then comes about the sales volume variance. Sales volume variance is equal to, now the difference in the number of units. The number of units are 580 and 620. These are the difference in number of units. The number of units applicable at the standard profit. Volume variance is about the standard profit per unit into the difference in the standard units minus actual units. Then profit is different things for different situations. So in marginal costing, it is contribution, which is considered as profit, which is controllable profit. But in case of absorption costing, it is the full profit. That is full total cost is deducted from sales, and then we have the profit. The point is, we do not have the details about what is fixed cost. That's not mentioned here. All what we have is only the variable cost. So irrespective of which method they are following, we have no other option here, but we can take the standard profit to be as the selling price. Standard profit is, otherwise I'll write it here so that you will have an understanding. Standard profit is equal to, the standard selling price is 13 minus standard variable cost is 4. So standard profit is equal to 13 minus 4 is equal to 9. None. So we can also, the units are already given. So sales volume variance is equal to 9 into 580 minus 620. So they actually sold more number of units than what they have decided. So which is equal to 9 into the difference in this 620 minus 580. So 360, and 360 is a favorable variance. So that is how we calculate. That is sales price variance. Let's get back to the so reconciliation would be cost variance is equal to price variance plus usage variance. So verify whether the calculations which are taken up are correct or not. So that is how the reconciliation would be taken up. So then coming to what is the criticism of standard costing. What is the criticism of standard costing? It is not appropriate in dynamic environment. See, dynamic environment, now this is what is decided here is what should be the standard is decided, and when the actual things take place, it is comparison with the, what, after after it is implemented, after it is already spent or earned, then it is verified with what was decided as a part of the planning, as a part of deciding the standard cost. They are compared. It doesn't accommodate anything which is changing in the current period. So those things, so and at the time of planning, if things were not anticipated, then the changes are not a part of the standard costing. So it is not appropriate in an environment which is dynamic, which is ever changing, which is constantly updated. So this is not very suitable for a dynamic environment. Now, standards, they have to be continuously updated. When they have decided the standards and the actuals, if they do not take place, then standards also have to be revised. See, yesterday, one question, when they decided the standard at for one unit, then later on, after verifying what is the actual activity, the standard is set according to that. Otherwise, let's say standard is decided for 500 units, the actual took place at 600 units. Even after preparing the standards, then again they have to be updated according to 600 units. That is what has to be done. Standards must be updated regularly. Then it says doesn't promote continuous improvement, use ideal standards. They use generally in the best scenario, ideal possible scenario, what should be the standards is what is decided. More automation, labor variances, less relevant. In variance is useful only when the work is carried out by manual hours, so the labor hours. But if the organizations have moved towards automation, if they are depending too much on technology, automation, digitization, and all, so there it should be the appropriate way to verify that is by the use of machine usage. Here it is labor usage. So labor variances are less relevant in such scenario. Develop standards for machine times and machine operating costs. Then products less standardized, more bespoke products. Um, Identify standard components and activities. Then we move into the next part of planning, which is budgeting. In simple terms, first we need to understand what's the meaning of budget. What is budgeting? What is budget? Budget is a financial plan. A plan which includes the details of expenses, incomes, assets, liabilities. We call that to be as a budget. So assets and liabilities, all those things which are in quantitative form, if they are a part of the plan, then we call such a plan as a budget. The process of preparing budgets is called as budgeting. The process of preparing budgets is called as budgeting. See now, here we see there are certain purposes of preparing budget. Why are they prepared? So that has to be understood. Why is that the budgets are prepared? Um, the reasons are planning, controlling, evaluation, communication, coordination, motivation, and authorization. Planning, plan for what should be what should happen in the future. So be prepared. What would be the course of action in future for the activity which is anticipated. So step number one, it starts with, see, before the budgeting there is some amount of forecasting taken up. So the level of activity at which um, uh, the level of activity which would be taken up in the future would be first forecasted. After the forecasting is done, then based on the forecasting, planning will be taken up. So budgeting helps in planning for the future. So forces managers to think ahead. After planning, then this becomes the base for controlling, but controlling is little later. But after the plan, the implementation takes place. The implementation, whatever is planned, at the time of implementing, it has to be verified whether implementation is according to the plan, whether they are taking up the actions according to what they have initially decided. So the implementation, then after implementing, the implementation should be um, compared with the plans. So they have to ensure that the implementation is as per the plan. If at all, if there is um, deviation, if the plan is not properly implemented, then corrective measures are taken to implement it appropriately. Okay, so from time to time, verifying whether it has to be um, it, it is implemented appropriately. Did I explain to you about the example which I asked you to remember, that um, we can connect this to an example called as Google Map. Google Map, did I explain? No, I don't think. Very recent example. See, the whole process of budgeting, you just remember how the app Google Maps app works. So that is how you remember. You must have used it, isn't it? So when we have to go to a new place, then if we are not aware of the route and all, then we take the help of this app, mention the destination in the app, and then we are set out to go to the new place. But after a while, if we want to verify whether we are on the right track, we open the app and then look into the app to understand whether we are going in the right direction. So the app also indicates that if you are on the right direction, it indicates you are there on the right direction. But let's say if you have taken a deviation, a wrong route, app also indicates that you've taken a wrong route and what is the best possible way for you to come back onto the right track. So that is also indicated. So the same concept here also you remember, that is when there is a plan. So what is that you want to achieve is your destination. So when you are implementing that, so you're on the when you are set out to go to that place, so you're implementing that, but then you also want to verify whether you're implementing it appropriately. So what do? You open the app and then check that. So compare about, is this the right track or not. If it is not the right track, control measures are taken to control the deviation. So that is what is a simple concept which you can very quickly and easily relate to that and remember also. So planning and control go hand in hand. So when the implementation takes place, at that time, the actual activity is compared with the planned activity, and if at all there is any deviation, measures are taken to correct the deviation. So that is what we understand here. Then apart from that, there are certain other purposes also. Once there is a plan prepared, plan is communicated to everyone in the organization, because there are people who have to implement this plan. So they should be aware of what is the plan. So that has to be told to them. After that, after the plan is communicated, everybody understands what the plan is. So they work in coordination. So everybody understands there is one plan which has to be implemented, so they work towards achievement of the same plan, so that coordination is possible. Communication says targets can be communicated throughout the organization. Coordination says that managers consider how their activities affect others. So um, they understand what is needed, because everybody has to achieve the same organization objective. So accommodating each other, they proceed further. Then it acts as a motivating factor. It is the source of motivation, because there is a comparison, there is an evaluation of the performance. How are they implementing the targets is verified, it is looked into, it is compared all the time. So there is a possibility of noting down the effective or best performance. Performance is evaluated, and when performance is evaluated, it acts as a source of motivation. So they, because based on the performance, rewards also can be given to the employees. So it is a source of motivation. Authorization to prepare the budgets at decentralized level or at division levels, when budgets have to be prepared. So the managers of those divisions are also given authority, so that based on that they can take appropriate decisions, plan for the future, and then implement that. So these are the purposes of budgeting. There are levels of, see, there are three levels in the hierarchy of management. There in the organization structure, there are three levels: the top level, the strategic level, what we call it as the budgetary level, and the operational level. The strategic level is the top level. They are involved in planning for the organization as a whole. So their plans involve the entire organization as to what the organization would be doing as a whole. That is, what products or services will they produce, what are the markets in which they would be present, where would they sell their products and services. And it generally includes, see, that's a broader vision for the entire organization. So a longer period of time is taken into consideration. Where would they want their organization to be placed in the long run is what is looked into by the strategic level. So that is what they decide. Then the middle level, we also call it as tactical level, functional management level. So see, once the plan is prepared for the entire organization, that has to be executed, that plan. Now, how is it possible to achieve those targets? Then what is the course of action which has to be taken up by the people internally? So if they decide on product A, B, C would be produced and sold, how to produce them also has to be decided. If the decision about the market 1, market 2, market 3, they would be present and sell their products, if that is also decided, how to achieve that, how to plan for that, producing so many products has to be decided. So that is decided at the middle level. So budgetary is short to medium term plans, steps towards achieving the strategic plan. To achieve the strategic plan, the next level of planning taken up is the budgetary level. Then operational is, they are the ones who are involved in implementing the plan. So they look at a very short period, immediate requirement. So their plans are generally involved for a very short period. So as short as what has to be taken up every single day will be looked into by the operational level. They are the ones who are involved in implementing the plans. So there is a budget manual which is prepared. Budget manual includes explanation of budget process and objectives. There's an organization chart prepared, a timetable. Then we see copies of forms, account codes, key assumptions, and budget officers. There is a way in which the budgets are prepared. There is a committee appointed. Then experts are also appointed in their respective field for each type of budget. Then coordinator to coordinate all the activities. So then um, see, after considering various inputs, budgets are prepared. That is about what we have in a budget manual. Tomorrow is the last class, no? So tomorrow, if we do that, I'll check it out tomorrow only. But as of now, I will explain to you how budgets are prepared. So please make a note of the budgeting, various types of budgets. I'll put it on a Word file. You please make a note of what budgets are prepared. Then after that, I'm not sure whether time would be sufficient tomorrow. After doing that topic, if still some more time is left, maybe I will take up one or two questions from the exam kit and then we can work it out. But as of now, let's look into what are the budgets which are prepared. So we will understand that. The first and foremost budget which is prepared in the organization. See, broadly speaking, there are two types of budgets. One is operating budgets, And then the second one is we see that there are financial budgets. So what is the main operation of the business is the main activity for them is buying and selling. What is bought is raw material is bought, then what is sold is finished goods are sold. So everything which starts from the purchase of raw material, converting it into finished goods, and then selling these finished goods is a part of the main operation. Okay. So under operating budgets, all the activities which start from buying of raw material and until selling of finished goods, every activity is covered under that. So under operating budget, the first and foremost budget which is prepared is called as the sales budget. So sales budget is uh, based on the estimation of forecast for the future. How many number of units would be sold is what is first decided. So they estimate maybe with the help of forecasting techniques or observation of the past data. They understand that this would be the number of units which will be sold for the next period. So decide on what are the number of units and decide on what is the selling price per unit. So one second. I was just looking at if I recently I have written that budget details in some file. Nevertheless, I will once again write. You also please make a note of what are the various types of budgets. First, we see that operation. Under that, the first budget is sales budget. How is sales budget prepared? Sales budget is equal to the number of units to be sold into selling price per unit talks about what is sales budget. So selling price per unit, if it is decided, how many number of units would be sold if it is forecasted, sales budget can be prepared. See, when the number of units which would be sold is known, then a decision about how many number of units would be produced also will be decided. See, the reason is as many number of units which would be sold, production is usually not taken up equal to that. The decision would be to produce more number of units than what they can sell. Why? The reason is in case if there is any unexpected demand for their products, if demand increases, to accommodate that increase in demand, they usually take up the decision to produce more number of units than what they can sell in the future. So more number of units will be produced. So how many units would be produced is the next step is what is production budget. But production budget will be prepared. So if production budget is prepared, number of units to be produced is equal to yesterday also I made you write the trading account. in trading account, what do we have on the debit side? We have the opening stock. Then the number of units which are produced, or the cost of the units is accounted in the trading account. But if we put it as the number of units of production, then this is the available stock out of which we see the sales happen. Certain units are sold, and then we see that closing stock is there. So considering this logic, this equation, now if this plus this is equal to this plus this. So if we want to find out what is the number of units of production, the equation can be written as, see, take opening stock to the other side. So it would be sales plus the closing stock minus the opening stock. After the number of units to be produced is known, then for the production, what is required? The production part of it, material is required, labor is required, overheads are required. So the next budget which is prepared is called as the materials budget. Materials budget. Materials budget, how is it prepared? So it is about the purchases. Material is about the purchase. So how many units have to be purchased? Number of units to be purchased is equal to the same logic like what we have, sales plus closing stock minus opening stock. We would now consider a production, how many units are required for production, plus the closing stock minus the opening stock of raw material. Now here we wrote, in case of production, it is the closing stock of finished goods and opening stock of finished goods. But here in case of the materials, so it would be units required for production plus closing stock of raw material minus opening stock of raw material. So that's the equation. Then what is the cost? Find out the number of units of material, multiply it into what is the price per unit or cost per unit of those materials. So we get to understand about what is the cost of materials purchased. Next one is labor budget. Labor budget has to be prepared. So in case of labor budget is again very simple. It is the labor cost is equal to number of labor hours into rate per hour. That's it, as simple as that. Labor hour. Only thing what we have to remember is labor is also of various types. That is skilled workers, semi-skilled workers, unskilled workers. They are paid at different rates. So all of them are not uniformly paid. So we just have to keep a track of what is the rate which is applicable to each category of workers. So labor cost is prepared. Then after that we have the overhead budgets. Overheads are indirect expenses incurred at production, that is at factory for the production purpose, at administration, at selling and distribution level. So under overheads budget, we have production overhead, budget. Then we have administration overhead budget, then selling and distribution. Selling and distribution budgets. These are the budgets which have to be prepared. So we need to understand whether they're variable in nature, fixed in nature, or semi-variable in nature. And according to the nature of these overheads, the amounts are estimated. Fine. Then these are the budgets which are prepared under operating budgets. Sales will give result to production budget, the preparation of production budget. For production, material, labor, all other expenses, also called as overheads expenses, so they are prepared. So together we can adding up all these costs, we can find out what is the cost of sales. So together material, labor and expenses, cost of sales can be calculated. After that, the overheads which are incurred at the administration level, overheads which are incurred at the selling and distribution level. So all of them together, it is possible to prepare a budgeted income statement. Budgeted profit and loss account can be prepared, because every component of income statement, starting from sales, cost of sales, then every other aspect is estimated, the budget is prepared. So a budgeted income statement also can be prepared. Then later on, a budgeted balance sheet also can be prepared, because the other financial budgets which are there, under that we have a capital budget prepared and a cash budget. So with all these information, it becomes possible to even prepare a budgeted um, financial position, that is the budgeted balance sheet can be prepared, and a budgeted cash flow statement also can be prepared. So that is a possibility. Of course, we are not tested questions at that level, but that is a possibility. These are the number of budgets which are prepared. So uh, the composition of all these budgets, that is operating budgets and the financial budgets. Under operating budgets, all the types of budgets which are included, and under financial budgets, the capital budget, cash budget, budgeted balance sheet, budgeted cash flow, all of them when they are prepared, the set of budgets together, we call that to be as a master budget. It's a comprehensive budget which includes all the other sub budgets. So that is a master budget. So how do we work out the numerical questions? So tomorrow, depending on the availability of time, we will look into that. Then coming to the financial budgets, under financial budgets, capital budget, we have an exclusive chapter, so we are not touching it now. Then the cash budget. So what is cash budget? Why do we have to prepare a cash budget? See, the point here is um, cash, when it is kept idle, cash kept idle does not give any returns. So You put cash in a box and then open it after a while, after few years also it would be the same thing. It will not give any return. So generally cash is not kept idle in the business. It is rather invested in some investment opportunity, so that there is some amount of return which can be earned. With an intention to earn a return, cash is usually invested. Then on the other hand, we also see that when payments have to be made, cash is required. If the payments are not made on due date, then the reputation of the business gets affected. So payments, or to make the payments to meet the expenses, cash is required. So we see that dual opinion. That is, one thing is to maximize the profit, cash should be invested in some investment opportunity. At the same time, some amount of cash also should be maintained, because to meet the expenses, to take up the operating activities, cash is required. So how much cash is required during a period is what has to be understood. So what is the ideal amount of cash balance which has to be maintained, to know that a cash budget is prepared. So step number one, first day. The first step is they start preparing what are the cash receipts. So what are the sources from which they would receive cash? The cash will be received whenever they sell the products. Sales happen, then cash is received. So keep a track of what would be the expected cash for a future period time. So let's say for the next month, if a cash budget is prepared, generally cash budget is prepared for a short period of time to understand the requirement of cash. So let's say the next month, how much cash is received, how much cash would be received is what is first understood. Then during that period, how much cash is required to be paid for various things, that is to purchase material, payment to the supplier. Then operating expenses like rent has to be paid, wages have to be paid, salary, other operating expenses, cash is required. So what are the expected payments also will be understood. After that, compare how much is received, how much has to be paid. Then if they have sufficient balance or not will be assessed. The receipts are more than payments, they understand that they would have sufficient cash. If the receipts are less and payments are more, so they understand that additional cash is needed. So when additional cash is needed, so they make certain arrangements to borrow it from other source, borrow some amount of cash, and then meet that expenditure, to see that they are able to meet all their expenses, cash expenses, promptly. See, if they do not make the payment promptly, reputation of the business gets affected. So that is a risky thing. So ensuring that all payments are made on the due date, there is an assessment of what is the amount of cash requirement has to be assessed. Then here there is one image which is given. So what is the cash budget? It shows cash effect of all decisions. Then vital planning document. It includes only cash transactions. See, in P&L account, we see that there are many transactions which are non-cash transactions also, like depreciation expense, depreciation, amortization. It is an operating expense, so it is recorded. But on account of depreciation, amortization, etc., do we see there is any cash going out of the business? No, it is a non-cash transaction. So eliminate all non-cash transactions and include only cash transactions. Then it also includes bad and doubtful debts. Any loss which is arising that is also not resulting in a cash payment. Loss on sale of assets, bad and doubtful debts, the provisions created, they are not resulting in any cash flowing out of the business. So they are also not included. Then that is the cash budget. After that, there is an image which is given about explanation about what is the possible cash position. So we see a short term, then a long term, a surplus scenario and a deficit. When do we have surplus? When the receipts are more than the payments, it is a surplus situation. When the payments are more than the receipts, it is a deficit scenario. So if there is a surplus in the short run, if they have a surplus in the short run, so I'll write it here. The cash receipts minus cash payments is called as surplus or deficit. If receipts are more than payments, we call it as surplus. If payments are more than receipts, we call it as deficit. If at all, if there is a deficit, arrangements will be made, some borrowing will be taken up, and then they would meet the requirement of this cash requirement. See, if there is a deficit wherein the payments are greater than the receipts, and if that is in the short run, make an arrangement for a bank overdraft, and then that will decrease the working capital. What is working capital? You must be knowing about the concept of working capital. Working capital is equal to current assets minus current liabilities. To ensure that they have more number of current assets than the current liabilities, um, the investment into current assets is made almost double the amount of the current liabilities which they have. So the plan would be taken up in such a way that their current assets are more than the current liabilities. So the excess of current assets over and above the current liabilities is working capital. So out of current assets, all current liabilities are paid, and any excess amount which is available, that will be used for meeting their day-to-day expenses. It is used as working capital. So that's the equation. So when the current liability increases, it will have an impact on working capital, that this working capital will decrease. That is what is mentioned. If at all, if there is a deficit in the short run, bank OD can be arranged, and that will decrease the working capital. But let's say that this deficit is in the long run. If it is for a longer period of time, in that case, then they have to raise long-term finances like debt capital or equity capital has to be raised. If they have more cash, that is surplus cash is there, it's good thing. If surplus cash is there, it is good thing that they will be sufficiently meeting all the current liabilities. That is a good thing. But too much of too many items of current assets, or um, too much of current asset availability or surplus availability is also not a good thing, because if it is in the idle form, they, there is no return which can be earned. So if they see lot of surplus available, then this surplus would be invested into some investment opportunity. Okay, so some investment it will be invested into. See, this availability of surplus, if it is in the short run, so short term investment. If it is in the long run, they see that they have more amount of cash than their current liabilities, then the investment into long term assets will be taken up. They would invest in long term assets. So that is about the various possible cash positions. I hope it is clear. Theoretical, this is all. You can also understand this one. Let's understand what are the various methods of budgeting. What is budgeting? The process of preparing budgets is called as budgeting. What are the methods of budgeting? First, let's start with the incremental budgeting. See how a budget's prepared. How a budget's prepared is the past budget is taken as the base. In the last period, if there was a budget which is already prepared, so take that budget, it is applied for the next period as well. So the past budgets become the base for the future budgets. Certain incremental changes are made to the past budgets and incremental budget is prepared. So that's the normal way of preparing budgets. So we call it as incremental budgeting. So contradicting to incremental budgeting is zero-based budgeting. Zero-based budgeting is a budget where nothing of the past is assumed. They do not assume anything of the past. Take up the present scenario and plan everything which has to be included in the budget. They plan every item and then prepare a budget. So why are they including? Let's say that material has to be included in the budget. So what is this amount? Why is it the appropriate amount? Justification also has to be provided. If material item is decided as 10,000, how do they decide on that? So there's some research work taken up, then they decide on what is the material cost and also include a justification as to why is this the right amount. Okay, that is zero based budgeting. Zero is taken as the base. That is the past budgets are not taken as the base. See, the incremental budgeting is easy to prepare budget because already there is a base. They just have to make certain changes. So easy and simple to prepare. But let's say that if in the past budgets there are some inefficiencies, some excess amounts are included, okay, excess costs are included, then uh, that inefficiency will continue into the future also. So because they do not look into the budget, the figures intricately, they do not make any amendments or changes. Only they incorporate the anticipated changes, but they do not verify about whether the amounts are appropriate, the right amount of figures are there in the budget. That verification is not taken up. So the past inefficiencies will continue into the future also. Okay, that is one disadvantage of incremental budgeting. Now coming to the zero-based budgeting. To eliminate these inefficiencies from the budget, zero is taken as the base. Zero-based budgeting is taken up. Zero-based budgets are prepared. So we see that no inefficiency of the past will continue. Everything is freshly um, anticipated. They are also justified. So the right amounts are included. But the disadvantage here in this case is it's time consuming and costly. Somebody has to be continuously be involved in preparing the budget. So it's time consuming and costly. Zero based budgeting. Then we see coming to this one, these are the other two types of budgets. One is imposed budget, the other one is participative budget, contradicting to each other. Imposed budget is also called as the authoritative style of budget. It is imposed. What does it mean? It is prepared by the top management. It is imposed on the people in the organization that they have to take up this and then implement that. It is imposed on them, imposed budget. But on the other hand, um, when people in the organization are called in to contribute their feedback, based on the feedback, they are asked to participate. So based on their feedback, budgets are prepared. So we call that to be as a participative style of budget. So imposed budget, the budgets are prepared by the top management. They are prepared and they are communicated to others in the organization, and they others have to take it up and then they have to achieve the targets. Advantage is it is simple and easy to prepare. Simple and easy to prepare budget. Okay, less effort. Uh, Disadvantage is it is demotivating for the employees who are working there. They feel that it is just imposed on them. Their opinion was not counted at all. So that is demotivating for the um, employees who are implementing these budgets. It says that budgets are set from the top without giving budget holders any participation in setting budgets. So it's demotivating to them. On the other hand, participative style of budget, various levels of management and employees from various levels are called in to contribute their opinion about what are the budgeted figures. Because the ones who are involved in implementation, they understand these details better. So feedback is collected from them and that is included. So they are made to participate. If they are made to participate in the budget, that would be a right thing. That is, they feel motivated because their opinion matters. That is counted. It is included. They feel motivated to achieve the targets. That is seen. That is an advantage here. There is also a disadvantage here in case of participative style of budget. First thing is time consuming because people are called in to contribute their feedback. It is a time consuming process because they have to sit and collect the feedback, and then because many people are there, all of them agreeing upon a particular thing is a little difficult. So then many rounds of discussions take place, negotiations and discussions take place, time consuming. Finally, something is agreed upon and that is implemented. So this is what we see in case of participative style of budget. More than this is another disadvantage which is called as budget slack. Slack is, see, because they are asked to contribute the feedback, they are asked to give their feedback and talk about what is the appropriate amount which has to be included. See, we have understood that budgeting, there is one purpose of budgeting which is also the controlling part of it, evaluation. So evaluation talks about evaluation. Here we see evaluation. Evaluation talks about comparing the their performance with what is the planned performance, what is the budget that is also compared. So because in future they would be compared, they do not include a tight difficult standard or a standard which is in the real sense the appropriate amount. Rather, they include a budgeted figure which is very easy to achieve. It's not so that those are loose standards. They are not the appropriate standards, loose standards. Let's say if a cost of a particular thing activity is 10,000, they may contribute it to be as 12,000. So they don't have to put in too much of effort to ensure that cost is within that limit of 10,000. So they include a higher amount as the um, budgeted figure. So in this way, there is inefficiency creeping into that. There are loose standards included in the budget. So that we call that to be as a slack, budget slack. That is a disadvantage of participative style of budget. Then we have another two types of budgets, which are rolling budgets and periodic budgets. Periodic budget is for a period of time the budget when it is prepared. So for a period of time. But let's say for the next 1 year, if a budget is prepared, or some period the budget is prepared. So during that period of time, right from the beginning of the period until the end of the period, if things are not uniformly the same, like in a seasonal business, every month it would not be the same. So it is not applicable for throughout that time period that such a budget can be prepared. That cannot be taken into consideration. Or certain businesses or certain industries, we see that there are very frequent changes taking place. Technologically, there is too much of advancement, and then very soon, very quickly, we see that changes are happening. So, in such a situation, considering a longer period of time and for which a budget is prepared, rather, um, the suggestion is to break down that longer period of time into shorter periods. For example, instead of having a budget for one full year, split that into 4 different quarters. Or instead of having a budget for one quarter, split it into 3 different months. So in a year, instead of preparing one quarter budget can be split down into 3 months. Let's say the first quarter, January, February, March. If in a year, for the year, if the budget is prepared, prepare it as quarter one, quarter two, quarter three, quarter four. So for smaller periods, so because uniformly they are not the same, so budgets are prepared for shorter period of time. So let's say that in a year, if they have the budget prepared for quarter one, quarter two, quarter three, and quarter four, then when the time passes by, the first quarter ends,